If you've been glued to the news, waiting for mortgage rates to finally drop off a cliff so you can buy your dream home, we need to talk. Because the Federal Reserve just wrapped up their first big meeting of 2026, and they threw us a curveball. They hit the pause button. That's right. After giving us a glimmer of hope with those rate cuts starting back in late 2025, the Fed has decided to hold steady. No cuts this time. So, what does this actually mean for you? Well, if you're a buyer, are you doomed to high rates forever? Or if you're a seller, did you miss your window? And why, despite everyone predicting relief, are we seeing rates bounce around like a rubber ball? In today's video, we're going deep. I'm taking the latest data hot off the press, analyzing the Fed's decision, the labor market numbers that are secretly scaring economists, and most importantly, giving you the playbook on how to navigate the 2026 housing market. So grab your coffee, maybe a notepad, and we have a lot to cover. So let's dive in. Okay, let's start with the facts. The Federal Reserve met recently and decided to leave interest rates alone. Specifically, they are keeping the benchmark rate in a target range of 3.5 to 3.75%. Now, if you've been following this closely, you know that back in September 2025, we finally started seeing some cuts. We had 3 rate cuts in a row. It felt like the momentum was finally on our side. But this month, policymakers said, whoa, let's wait a minute. Why did they do this? It comes down to 2 big, scary words: inflation and unemployment. The Fed has a dual mandate. They need to keep prices stable, fight inflation, and keep people employed. Right now, inflation is being sticky. It's hovering above that magic 2% target the Fed loves so much. Prices on groceries, electricity, and heating are still creeping up. If the Fed cuts rates too fast, they risk pouring gas on that fire and sending prices skyrocketing again. On the other hand, the job market is stabilizing, but it's fragile. We'll talk about jobs later, but essentially the Fed is in a wait-and-see mode. Former Cleveland Fed President Loretta Master put it best recently. She said, the Fed is in a good position to hold for a while. Basically, they don't want to make a mistake. They'd rather keep rates a little higher for a little longer than cut them too early and ruin the progress they've made. But for us, in the real estate world, this patience can be frustrating. This brings me to the biggest misconception I hear from clients every single day. I had a buyer call me yesterday and say, well, the Fed didn't cut rates, so mortgage rates are going to stay high, right? Not necessarily. And this is crucial for you to understand. The Fed does not set mortgage rates. The Fed sets the rate for overnight borrowing between banks. Mortgage rates, on the other hand, tend to follow the 10-year Treasury yield. They are influenced by the Fed, sure, but they are driven by future expectations of inflation and economic growth. Here is the silver lining, though. Mortgage rates can, and often do, fall before the Fed even lifts a finger. We actually saw this happen back in September of 2024. Mortgage rates dropped 40 basis points in a month before the Fed even announced a cut. Why? Because the market anticipated a slowdown. So what is the forecast for 2026? Well, even with this Fed pause, experts Bankrate and other financial institutions are predicting mortgage rates will bounce between a low of 5.7 and a high of 6.5%. Currently, we're seeing the 30-year fixed average hovering around 6.25. If you have strong credit, you might be seeing offers in the mid to high fives. The takeaway here, don't watch the Fed announcements and think that is your mortgage rate. Watch the 10-year Treasury. Watch the inflation reports. If the economy shows signs of slowing down, mortgage rates would likely dip, regardless of what the Fed does at their next meeting. Now, I have to give you a bit of a reality check. Everyone is praying for rates to drop to 4 or 5%. But there is a catch, a major catch-22 that nobody likes to talk about. If mortgage rates drop significantly, what happens to buyer demand? It explodes. Suddenly, all those buyers who've been sitting on the sidelines for the last 2 years jump back into the pool. But here's the problem: inventory. We still have a supply shortage in many markets, including right here in South Florida. If rates come down, it doesn't mean the price of the house is going down. In fact, it's the opposite. If rates drop to 5.5% and suddenly 5 buyers are fighting for the same house, the price gets bid up. So you might save $200 a month on your mortgage interest, but you might pay $30,000 more for the house. This is why waiting for the perfect rate can be dangerous. You're trying to time a market that is incredibly complex. If you buy now, you might pay a simply higher rate, but you face less competition and can negotiate the price. If you wait for rates to drop, you might get the rate, but you'll be in a bidding war paying over asking price. It's a balancing act. And remember, inventory is the metric to watch. Until we see a massive flood of new homes hitting the market, prices are likely to remain sticky, even if the rates soften. Let's zoom out for a minute and look at the bigger economic picture, because your ability to buy a home isn't just about the interest rate. It's about your job and your cost of living. The labor market is weird right now. On paper, it looks okay. The unemployment rate is sitting around 4.4%. That's historically pretty low. But if you're out there looking for a job, you know it feels different. Hiring is at its weakest level since 2013. Companies aren't firing in masses, but they aren't hiring either. It's what we call a silent slowdown. Young workers and recent grads are feeling this the hardest. Simultaneously, the cost of living, groceries, insurance, utilities is still climbing. So why does this matter for real estate? Well, because lenders are looking at your debt to income or DTI ratio. If your income is stagnant but your living costs are rising, your buying power shrinks. However, there is some good news for savers. Because the Fed paused cuts, high-yield savings accounts are still paying out pretty well. You can still find accounts offering around 4.2% APY. If you're saving for a down payment, keep your money in those high-yield accounts. Don't let it sit in a traditional checking account earning 0.01%. Make your down payment money work for you while you wait. So we've covered the Fed, the mortgage rates, and the economy. Now let's get tactical. If you're looking to buy or sell in 2026, what's your game plan? Here are my top 3 recommendations. Number 1, ignore the noise. Focus on the budget. You cannot time the market. I repeat, you cannot time the market. If you have a life event, a new baby, a marriage, a job relocation, you need to move. So don't put your life on hold for 50 basis points. If you find a home you love and you can afford the monthly payment right now, buy it. You can always refinance later if rates drop, but you can't refinance the price of the home if it goes up 10% next year. Number 2, credit is king. The spread between mortgage rates for good credit versus bad credit is massive right now. Borrowers with excellent credit are seeing rates in the 5s, while those with average credit are in the 6s or 7s. Before you even look at a house, work on that score. Pay down high-interest credit card debt. Don't open new lines of credit. A 20% boost in your score could save you tens of thousands of dollars over the life of your loan. And number 3, watch that 10-year, not the Fed. Stop refreshing the news for Fed meetings. If you want a preview of where mortgage rates are going, just Google 10-year Treasury yield. If that number is going down, mortgage rates will likely follow. It gives you a head start on the headlines. And for my sellers, pricing is everything. We aren't in the unicorn years of 2021 anymore. Buyers are sensitive. If you price correctly, you will sell. If you overreach, you will sit. It's that simple. The bottom line is this. The Fed hitting pause isn't a disaster. And it isn't a miracle. It's just part of the stabilization process. We are moving toward a more normal market, one where rates are reasonable, inventory is growing slowly, and buying a home is a long-term investment, not a get-rich-quick scheme. 2026 is going to be a year of opportunity for those who are prepared. The market's shifting, and usually the best deals happen when everyone else is scared or waiting on the sidelines. If you're thinking about making a move here in Palm Beach County, or if you just want to run the numbers to see what's possible for you, reach out to me. I'm Albert Stepniak, a realtor with Coldwell Banker here in beautiful South Florida, and I make these videos to help you make sense of the headlines. If you find value in this, do me a huge favor. Hit that like button and subscribe so you don't miss the next market update. Thanks for watching, and I'll see you in the next one.